In some cases, an entity owns property that is leased to and occupied by its parent or another subsidiary. The property does not qualify as investment property in the consolidated financial statements because the property is owner-occupied from the perspective of the group. Because it's understandable for our level class to get confused with this one, especially that we have not yet talked about consolidated financial statements comprehensively, and we have not yet discussed PFRS 3 and PFRS 10. Okay, but let me try to give you a simple idea here, class. We have two companies, class, company A and company B. Okay, company A is the owner of the building, class. Okay, and the building is being used to earn rentals. And company B is actually the one who leased the property, class. So company A leased the property to company B. So company B is the one occupying the property. In the separate financial statements of company A, class, of course, the building will appear there. Okay? And since it is being held for rental, class, the building will appear as an investment property. Why will the building appear as an investment property in the books or the financial statements of company A, class? Because company A is the owner of the property and the building is used to earn rentals. On the part of company B, class, the building, even though it is the one using the property, class, will not appear in its financial statements. Why? Because company B is not the owner of the building. He is only leasing it. He is only the lessor. Okay, so lessors normally will not need to recognize the leased asset in their separate books. Okay, so no issue. Company B is not the owner of the building. He's only a lessee, so it will not be reported in his books. Company A will report the property in his books because he is the owner of the property. And no issue as to why it is classified as an investment property by company A because it is being held for rental. The issue now, class, is what will happen if company A is the parent of company B. What will happen if there is a parent-subsidiary relationship between company A and company B? Okay, so as to their separate financial statements, class, no effect. Okay, where then will there be a consequence? Only in the preparation of your consolidated financial statements. Okay, so in the consolidated financial statements, class, you would see it from the perspective of the entity as a whole, not just from the perspective of company A. Even though company A is the parent, your consolidated financial statements would be prepared from the perspective of the consolidated entity. So, in the eyes of the consolidated entity, class, everything that is being owned by company A and company B is owned by the consolidated entity. Again, everything that is owned by company A would be owned also by the consolidated entity. Everything that is owned by company B would also be owned by the consolidated entity. All assets that belong to company A belong to the consolidated entity. All assets that belong to company B belong to the consolidated entity also, in the eyes of the consolidated entity. Okay, so you just change the transaction, class, and replace company A and company B with the consolidated entity. So what is our transaction here? Company A leased the building to company B. And now company B is the one using or occupying the property. Okay? Company A leased the property to company B and company B is now occupying the property. Now replace company A and company B with the consolidated entity, class. So meaning, instead of company A, we would say consolidated entity leased the property to, instead of company B, we would say consolidated entity. And it is now the consolidated entity that occupies the property. So, to reiterate the entire sentence now, the consolidated entity leases the property to the consolidated entity, and it is the consolidated entity that occupies the property now. So, who owns the property? Consolidated entity. Who occupies the property? Consolidated entity. In that case, the property is considered now as owner-occupied. Because who owns it? Consolidated entity. Who occupies it? The consolidated entity. Even though in reality it's company A and company B. But in the eyes of the consolidated entity, he is both the owner and the occupant. So in the separate books of company A class, it's an investment property, but in the consolidated financial statements, it will not be an investment property. Okay? That would be a source of a very tricky question, class. Many students will get that wrong. I hope you get it. In the books of company A, since it is being held for rental, it would be reported as an investment property. In the consolidated financial statements, it would be classified as an owner-occupied property because in the eyes of the consolidated entity, it is both the owner and the occupant of the property. Okay? You should not be asked as to the books of company B class because the property will not appear in the books of the lessee. If you will be asked as to the books of company B, if you'll be asked from the perspective of company B, the question is just trying to trick you, class. Recognition, I hope everyone is familiar already with the recognition requirements that are very common for all assets. Requirements are probable and measurable. It is probable that the future economic benefits that are associated with the asset will flow to the entity, and the cost of the investment property can be measured reliably. Okay, please take note of the underlined portion of paragraph 18. An entity does not recognize in the carrying amount of an investment property the costs of the day-to-day servicing of such property. If these costs are present, class, then this will just have to be expensed. And this is similar also to the provision provided in PAS 16 class. Again, you will also find a lot of similarities between PAS 16 and PAS 40. Measurement, very important, class. An owned investment property shall be measured initially at its cost. Okay, so similar to the other assets we have already discussed, class. Initial measurement for inventories, cost. Initial measurement for PPE, cost. Initial measurement for intangible asset, costs. Initial measurement of investment property also at cost. Okay, but please take note, class, there's a special feature here. Transaction cost will be included in the initial measurement. Why? Because the transaction cost will be considered as a directly attributable cost, class. Remember that directly attributable costs will be capitalized. Okay, but since we are talking about an investment, the term being used here pertains to transaction costs. Okay, but again, so far they are all at cost, and we will have to include transaction costs as part of the initial measurement. Okay, paragraph 21, class, should be very familiar to you already by now. The cost will be its purchase price plus any directly attributable cost. Okay, and directly attributable cost will include professional fees, property transfer taxes, and other transaction costs. The costs that will not be included, class, are the following, and these should be familiar to you already: startup costs, operating losses, and abnormal amounts of wasted materials. Again, you've encountered this, if not from PAS 16 and PAS 38, you've encountered this from PAS 2 class. Okay, so basically the same rules will apply as to those that will be capitalized or not. Here, if under deferred credit terms, class, the same rules will apply. Okay, paragraph 27, exchange transactions, the same rule will apply. Okay, as to commercial substance, the same rule will apply as discussed in PAS 16. Okay, and just please take note of paragraph 29A. This could be a good source for a true or false question. An investment property held by a lessee shall be measured initially at cost. Now, measurement after recognition. Initial measurement at cost. Subsequent measurement, now different. Okay? Initial measurement of inventory, class, cost. Subsequent measurement, lower of cost and net realizable value. Initial measurement of PPE, cost. Subsequent measurement, either use the cost model or the revaluation model. For intangible asset, class, initial measurement is cost. Subsequent measurement is either under the cost model or the revaluation model. And now, past 40, this is what makes investment property unique, class. Initial measurement for investment property cost similar to others, but subsequent measurement, class. We also have two options, but the options here are the cost model and the fair value model. And this is where students would normally get it wrong because they would think that it's always cost or revaluation, cost or revaluation. Okay? Similar si past 16 and past 40. Past 16 and 38 are similar as to subsequent measurement. Malahi si past 40 because instead of revaluation model, it would be fair value model. And I've discussed already the difference between fair value model and revaluation model, class. The difference primarily lies on the frequency, class. You both change the carrying amount of their fair values, but under the fair value model, you will have to do it annually. Under the revaluation model, you only have to do it when there is significant change in the fair value. Okay? So please take note of the options available in past 40. It's fair value model and cost model, not revaluation model and cost model. Okay, so please take note. If you use the fair value model, class, then every time there's a change in the fair value, you will recognize a gain or loss. And where will the gain or loss be reported? It would be in the statement of profit or loss. Okay. To confuse you, some questions would ask whether the gain or loss will be reported in the other comprehensive income. That's wrong. Your gain or loss from the changes in fair value will be recognized in your statement of profit or loss. Why would students get confused, class? Because the changes, class, under the revaluation model, class, goes to your other comprehensive income. Changes in the carrying amount because of the increase in fair value, class, under the revaluation model will be reported as a revaluation surplus, which is to be reported as part of your other comprehensive income. But if you use the fair value model, class, the gain or loss arising from the changes in the fair value will be reported in your statement of profit or loss. Please take note as to where it will be reported. Revaluation surplus arising from revaluation, other comprehensive income. Gain or loss arising from change in fair value, statement of profit or loss. Okay? That would be also a commonly asked question. Okay, and there are also special rules, class, if it becomes difficult to determine the fair value of the property. Because if you will use the fair value model, class, again, you will have to keep on updating its carrying amount with its ever-changing fair value. But if it reaches to the point that it is very difficult to determine the fair value reliably, class, then the standard also provides us with the alternative or the options, class. Okay, but we will discuss this next time. By the way, class, for the application of cost model, the same as what was discussed in past 16. You use the historical cost and you provide allowance for depreciation and impairment. Another area, class, of past 40 that would be a rich source for questions, class, would be the rule on transfers. What will happen, class, if it was investment property before but reclassified as inventory? Is that possible? Yes, if there's a change in the purpose of the asset. Investment property before, PPE after. Okay? And what if it's the other way around? Inventory before, PPE after. Inventory before, investment property after. PPE before, investment property after. PPE before, inventory after. Okay? There are a lot of issues, class, because the measurement rules are different, man. If you use the fair value model, we will have a big problem. If everyone just uses the cost model, class, then there would have been no issue. Okay, the bigger issues under transfers, class, is if we use the fair value model for our investment properties. But again, we will discuss the rules for transfers, class, once we have allowed the more basic concepts for past 40 to sink in. Okay, gains or losses when the asset is sold will be recognized in your statement of profit or loss. This is not new or unique to past 40, class. Okay, gains or losses from disposals will be reported in your statement of profit or loss. But there is a need to emphasize this because again, the rule is different under PPE if you use the revaluation model. Okay, but if you did not use the revaluation model, then there would be no issue. Under the revaluation model for PPE class, if you dispose the asset, you will have to remove first the revaluation surplus and transfer it to your retained earnings. Okay, but that would not be our concern at the present. For disclosures class, please take note of the differences between the required disclosures for entities using the fair value model and the cost model. So to quickly summarize lang class, remember the definition of investment property. It's limited only to land or building, and it is held to earn rental or for capital appreciation. It is initially measured at uh, cost, subsequently measured at the under the cost model or the fair value model. Take note of the treatment for ancillary services. Okay, take note of the treatment if it's a multiple use property, and remember the examples given in the standard as to what will be considered as an investment property and what will be considered not an investment property. So far that should be all for today for investment property class.